Thank you, Carl. So I'm going to talk through the tax and benefit measures in the manifestos. Because I only have 20 minutes, I'm going to focus pretty much entirely on the Conservative and Labour manifestos, but I will draw a couple of parallels where they're enlightening to the Liberal Democrats as well. So to start on the tax side, really the first thing to say is, as I'm sure you know by now, is that this is really dominated by Labour's proposals. The Conservatives have announced very little that's new here, whereas Labour have on their scorecard a total of about £53 billion worth of tax rises per year by 2021, less about £4 billion of headroom that they've left for some downside risk, which I'll come back to. One thing to flag right up front, and you're going to hear more about this through the morning, is that we don't think Labour are going to get all of this money, and Carl will go through that a bit more systematically when he talks about the public finance impacts of the manifestos. I will, though, touch on a couple of the particular downside risks to this as I move through some of the specific measures. Now, this pie chart splits out the big picture of where Labour are proposing to get all of this money from. And probably the number one thing to note from this is how much of it would come from companies. That's true not just of the biggest single slice here, which is raising the rates of corporation tax, but also the next two slices are largely about trying to take more money in corporation tax. So overall, you've got something well in excess of £20 billion a year here just in aimed increases in the corporation tax take. To put that in context, we currently get about £55 billion a year from all corporation tax. So it gives you some sense of how big a scale of an increase they're looking for from that particular source. And other major revenue raises, which I'll go through, include an extension of stamp duty and some financial transactions, and direct tax changes, in particular changes to income tax for higher income people. The other segment here is essentially the stuff that I'm just not going to have time to talk about, I'm afraid. So basically the tax part of my talk is going to be structured largely around going through the big areas in this pie chart and comparing Labour's plans to what would otherwise happen. One really big important point I want to make here, given what this pie chart looks like, is that of course, whilst there are lots of interesting differences between different taxes that we can talk about, there is one very basic feature that they all share in common, which is that ultimately they have to fall on people. And that is going to be true of corporate taxes just as surely as it's true of the so-called personal taxes. So, for example, to take increases in the corporation tax rate, when a company writes a cheque to the government, money is not just coming from nowhere, it's money that ultimately would have otherwise ended up with a household somewhere at some point. In the short run, it probably would have ended up with shareholders for the most part, because in the short run, it's probably coming out of company profits. But of course, note as well that shareholders aren't just a tiny group of very rich people. Millions of people with private pensions are effectively shareholders as well, because that's what their pensions are invested in. And in the long run, there may well be and are likely to be other groups affected, namely workers in the form of lower wages and perhaps consumers in the form of higher prices. But one way or another, although we're uncertain about the details, inevitably, we do know that all taxes have to ultimately fall on people. Now I'm going to go through the major measures in turn. I'm going to start with the biggest single one, which is corporation tax. So this just reminds us of the context of what's happened to the main rates of corporation tax in recent history, in particular since 2010. Basically, they've come down a lot since the coalition government came in. This was part of a big strategy to reduce these rates of tax. There's also a plan already set in the pipeline by the current Conservative government to reduce the main rate of corporation tax further to 17%. And that would come at a further cost of around £5.5 billion per year. Now, what Labour plan to do is, first of all, not do that, and instead actually to raise rates back up again at a total cost relative to the current plans in their scorecard of around £19 billion a year. So by some way, the biggest single measure in their scorecard. Now, there are good reasons to think that actually, even in the short run, it will raise a little bit less than that, and Labour do acknowledge that as one of the reasons for the £4 billion of headroom that I mentioned earlier. But more importantly, in the long run, we would expect it to probably raise significantly less than that. Corporation tax makes investment less profitable, and we would expect that to reduce investment. Lower investment ultimately would mean lower national income, and that acts to reduce tax revenue. By the way, that's also one of the key mechanisms through which, in the longer term, we would expect at least some of the burden of corporation tax to fall on workers, because lower investment means lower productivity, and that means lower wages. But you can see it as a sense of perspective, despite the fact this is clearly a big tax increase, it wouldn't take us into uncharted territory here. We would still have a lower rate actually than we had in the recent past. And indeed, another sense of perspective worth pointing out is the international context. We'd still have, even under Labour plans, the lowest main rate of corporation tax in the G7. That said, there are other respects in which our corporate tax regime has become less competitive since 2010, in particular for banks, where we have a number of additional taxes, and there have also been reductions in capital allowances. So there would be some firms, especially banks, but other firms as well, who would pay more tax overall under Labour's plans than they would have been paying under a 2010 regime. Well, on the subject of the banks and the financial sector, that brings me to the next really major revenue raiser in the Labour scorecard, which is an extension of probably the kind of stamp duty you're less used to thinking about, not the one on housing, but the one we currently have on shares, where you pay 0.5% of the value of a share when it is traded. Labour have a plan to extend this tax to the trading of derivatives and bonds as well, and also to remove an exemption for intermediaries, so essentially think brokers here. And this they expect to raise coming up for £6 billion a year, so another really major revenue raiser. Now again, as with any non-personal tax, it's important to think carefully about who this would actually affect. As always, that's a little bit uncertain, we can't be sure, but one thing certainly you shouldn't be thinking is just because this is a tax on the financial sector, it's just a tax on rich bankers. One group who are effectively likely to be paying much of the tax ultimately are people, again, with private pensions. Essentially, this is like adding a charge to the trading of these financial products, so it just reduces the returns after tax to any savings that are invested in that form. And of course, pension funds trade in these things all the time. Now, what are the aims of this policy? Labour actually mentioned a couple of things in the manifesto. One is to eliminate the most destabilising forms of speculative high-frequency trading. So the idea is that there's some trading going on which is not really based on the fundamentals, on what people think assets are actually worth, but just on speculation. And this can have wider damaging effects on everyone else by creating bubbles or more generally higher market volatility. And so that provides some potential rationale for intervention to reduce that. The thing to say about that is it's unclear in principle whether it would act to reduce or in fact increase market volatility. It's perfectly possible that when you have a tax of this kind, if it reduces the amount of trading that's happening, it reduces the liquidity in the market, that could make asset prices more volatile rather than less. So it's unclear in principle, and unfortunately the evidence is also rather inconclusive on whether these taxes do in fact increase or reduce volatility in these markets. Now, there's a second aim that Labour mentioned, which is to ensure that the public gets a fairer share of financial system profits. This one, it seems harder to draw a straight line between this aim and this policy, given that it's not a tax on profits. It's a tax on transactions. One component of this package that does just look ill-advised is to remove the intermediaries exemption. Basically, this just means that shares that are sold via a broker rather than directly will be taxed twice rather than once, and there's no clear reason why you would want to do that. Now, anti-avoidance and evasion measures, this is something, it's a bit of a deja vu moment, because just a couple of years ago we were talking a lot about these at the last election when all the main parties were proposing lots of these measures, and it's happened again. This is a genuinely difficult area. That's not to say you shouldn't try and do anything about it, of course, but it is difficult, and there's unavoidably a lot of uncertainty about exactly how much you can get from measures in this area. Now, all the parties are talking about it again. In the Conservative case, frankly, like much of their manifesto, it's all rather vague. There's not much in the way of specifics, and there's no attempt to quantify how much they might expect to raise from the kind of measures that they discuss. On the Labour side, there is more in the way of specifics, and there is an attempt to quantify. And in fact, they're relying on this quantification because they're spending the money that they hope to raise from these measures. There's about £9 billion overall of measures that could be thought of as anti-avoidance or evasion. I've listed them here. The problem on the Labour side is that basically this just looks too optimistic in terms of what they're likely to raise. Looking through the list of measures, we think at least half of that £9 billion is unlikely to materialise. That's a combination of genuine mistakes, I'm afraid, in the costings, and also just estimates that look like more like upper estimates or optimistic estimates than genuine central estimates. Even the remaining half, it looks, if anything, like it comes with downside risk overall, in part because some of the measures aren't actually properly specified. They're more intentions to get money from certain parts of the tax system without precise mechanisms for actually doing so. Well, that brings me on to direct taxes, and in particular income taxes. And actually all the three parties that I mentioned at the start have got policies in this area. But what I want to do first of all is to set the scene by just showing you what our current income tax system looks like. This shows you the marginal rates of income tax levied at different levels of annual taxable income. I suspect most of this picture is going to look pretty intuitive and clear to you. The bit that might not be so familiar, at least if you haven't attended enough IFS events, is the bizarre spike in the marginal rate schedule between 100 and 123,000 pounds per year. Apart from not attending enough IFS events, you can be forgiven for being confused by this, because it is the opaque result of a policy that's described as withdrawing the personal allowance in gradual fashion as incomes rise above £100,000. All it does is create this 60% effective marginal rate band in the middle of what would otherwise be the 40% rate band. Now let's look at how the different parties propose to change this schedule. So with the Conservatives, they're proposing a couple of increases in tax thresholds, a very small and in fact imperceptible change to the personal allowance on this graph, and a slightly bigger and therefore just about perceptible change to the rate, to the point at which you start paying the higher 40% rate of income tax, so benefiting, small benefits there for higher rate taxpayers. Total cost of about £2 billion per year. The Liberal Democrats would implement a broad-based takeaway here, raising all rates by a percentage point. Again, it's Labour who make the biggest looking change to the structure of the system, that they would introduce new rates for those on higher income, so a 45% rate now starting at £80,000 a year, and also a 50% rate starting at £123,000 per year. Now, in combination with their new 45% rate, the fact that they would also leave in place the policy described as withdrawing the personal allowance would actually mean that that spike would not only remain, it would actually get bigger. It would go from 60% to 67.5%. For those of you torturing yourselves trying to figure out the arithmetic of that, I'm happy to walk you through it afterwards, but that would be the effect. It's really important to point out this is only affecting the top 2% of adults. So the vast majority of people would not see any change in their tax bill as a result of this. The top 2% of adults or the top 4% of those who pay income tax. Now, I haven't brought up a revenue number yet for Labour, and that's because I want to give that a bit more discussion. Because essentially it only affects the revenue from this measure would be so reliant on this top 2%, this very small group, there's a lot of uncertainty about the revenue it would raise. This is a group who, first of all, we're pretty uncertain about how much they respond to changes in their tax rates, and secondly, the amount of revenue you get from them is highly sensitive to the degree to which they respond. Now, by respond, I mean anything that they might do to reduce their taxable income as a result of a higher tax. So it might be putting more in a pension, retiring a bit earlier, or taking additional steps to avoid or even perhaps evade taxes. I think often there's some incredulity about how it is that responses can matter so much for revenue. It might seem a bit far-fetched to people. To give you some intuition why in this kind of case it really can matter, take someone who's already paying the 45p rate of income tax, and you're going to ask them to pay an extra 5p in the pound. Well, if they don't change their behaviour, then yes, you're going to get an extra 5 pence for every pound of income in the relevant range. But now take someone who does change their behaviour. Well, for every pound by which they reduce their taxable income, not only do you not get the extra 5p, you lose the 45p you were getting before. And actually, you'd lose more than that because you'd also lose the national insurance. So that just gives you some sense of the intuition for why it really does matter. It's not a second-order issue in cases like this, how much people respond. Now, for those of you who are really interested in this, I would just refer you to the source at the bottom where we go through this in detail, and we talk about the evidence on the degrees of responsiveness and what this would mean for the amount of revenue raised by this proposal. But basically, we look at different scenarios for how much it would raise to illustrate the uncertainty. Now, it's useful to split this into two parts. First of all, just think about increasing the marginal rates for those above £150,000 per year. And the reason I ask you to do that is because the rate for this group has already been increased in recent history back in 2010, and there was an official evaluation of the effect that it had conducted by HMRC. So thinking just about the rate rise on that group, given the central estimates from HMRC about how much they responded to that, that's what we're using in the medium responsiveness scenario here. That would suggest that increasing rates for that group raises overall very, very little because of how much they respond. But there's a lot of uncertainty around that. These two scenarios either side are also entirely plausible and within the margins of error, which imply that this measure could either raise up to £2 billion a year almost, or actually could cost about £1 billion a year. Now, of course, Labour's policy would not just affect that group. It would also affect people, the marginal rates between 80 and £150,000 a year. And the evidence we have suggests that that's a group who are probably somewhat less responsive than the group above £150,000. But again, there are different, there's uncertainty, and we've looked at different plausible scenarios for how responsive they are. But basically, this is the upshot you get when you add the revenue from the two groups together under the different scenarios. What this is telling you is that we think somewhere in the middle of a plausible range of scenarios here gives you a revenue yield of about £2.5 billion a year overall from Labour's proposal after behavioural response. If people are a bit less responsive than our best educated guess, it could raise significantly more, about £4.5 billion a year. And that, by the way, is pretty much exactly what Labour have indicated they expect this to raise after accounting for behavioural responses. But equally, it could raise somewhat less, about nothing in our high responsiveness scenario. And note that all of these are very different from what it would raise if there were no responses by anyone at all, which is £7 billion a year. So these responses really do matter. Okay, so that just brings me more briefly to benefits. I'm going to focus on working age benefits because that's where pretty much all of the action is, certainly over the next few years in terms of the policy plans. The first thing to say here is there are already really big cuts in the pipeline. So if none of the manifestos were implemented, it's not as if we would see no changes over the coming years. The Conservatives have already put in place a number of big cuts to benefits to come in over the next few years. The big ones are listed here: cuts to child tax credit, freezing most rates of working age benefits until 2020, and also rolling out universal credit, which will be less generous, significantly less generous on average than the system it is replacing. The big picture in terms of the manifestos is that the Conservatives will stick to all of these plans. Labour actually will stick to most of them. And the Liberal Democrats here are the ones who stand out most, and that they would cancel most of these cuts. A bit more detail on that. This brings up the three big areas here in the Liberal Democrat manifesto in terms of reversing benefit cuts. It's pretty much repeating what I just showed you on the previous slide. So reversing cuts to child tax credit, stopping the benefit freeze in its tracks now and starting to inflation uprate again, and also reversing the cuts to work allowances in universal credit that have been made recently. These account for much of the reason why universal credit is set to be less generous than the system it replaces. So the Lib Dems would reverse all of these things. Labour don't allocate anything towards doing anything about the first two of these policies. They do allocate £2 billion towards a review of universal credit. So they could, in principle, reverse about 2/3 of those cuts to the work allowances, or they could choose to use that money in some other way to make the universal credit more generous than it's currently planned to be. And as I said, the Tories would just stick to the current plans. Now, putting those to the top of the table and just putting in a few more smaller measures that are in the manifestos, basically the punchline here is that both Labour and the Liberal Democrats would reverse some of the smaller cuts that have already been implemented. And there's a few of them listed here. Now, bringing much of this together, we can think about the impacts of these measures across the income distribution, which groups would be affected most. Again, it's really important here to come back to the point I made right at the start. We can do this for personal taxes and we can do it for benefits because it's pretty transparent precisely which households are affected by these things. But don't forget that other taxes, in particular here corporate taxes, will also affect households. We just don't know which ones precisely. So that's not included here, but it doesn't mean it won't be affecting households. That's a big caveat to please bear in mind. Now, what I want to first do is bring up the current plan. So this is if ignoring any of the manifestos, if nothing changed, if what was already in the book was simply implemented, the current Conservative government's plans, this is what the measures would do to incomes across the distribution. This is basically the big benefit cuts that I just talked about, hitting low-income, particularly working-age households, especially hard. Turn those bars into a line, and now I'm going to add on how this would change if we add in the proposals in the different manifestos. Now, in the Conservative case, essentially nothing. There's almost nothing in the Conservative manifesto that would change the current plans on personal taxes or benefits. On the Labour side, as I said, they would not go ahead with some of the cuts, but they still go ahead with much of them. So overall, there would still be a significant takeaway from measures implemented under a Labour government, taking the manifesto at face value, from lower income households on average. It is the Liberal Democrats here who stand out the most. I should say, of course, at the top, Labour would take significant chunks of money away, driven in large part by the income tax measures that I just went through. Towards the bottom, it's the Liberal Democrats who stand out by far the most, because they would cancel most of these cuts, as I just mentioned. Okay, so to conclude, the Conservatives are largely sticking with the plans that they've already laid down, but don't forget these are themselves substantial. On the benefit side, there are big benefit cuts that are already in the pipeline, and they will hit low-income working-age households relatively hard. Labour are proposing big changes from this. Overall, it seems very likely that they would act to reduce inequality overall, certainly at the very top end, given how tightly targeted their income tax changes are on that group. But more broadly, there is a caveat to that. Taking their package as a whole, it really is inconceivable that it would all merely affect the top 5%, that the tens of billions of pounds they would raise, for example, from corporation tax would merely affect such a small group. They would also affect more ordinary households too. And that's just because all taxes ultimately have to be paid by people. There is no one else to pay them. Only a small fraction of Labour's extra revenue is actually earmarked for benefits. It's the Liberal Democrats in that area who would go further in cancelling the planned cuts. But that, in large part, is because Labour are focusing much of the increases in spending on other areas of spending. And that's what Rowena's going to talk through now.